Good afternoon and welcome to today's session. My name is Gary Kayle. I'm the CEO and a money coach at Worth Financial Education, and I'm going to be hosting the session for you today. I'm just going to give it another, minute or so. We are expecting a few more attendees to join us today, and just want to give them a chance to come in, and then we'll get going. If you do have any questions for me, you're welcome to just pop them into the question block that you'll see on your screen. And I might just hold those questions till the end, depending on what you're asking, but I will be able to see it. Okay. Just going to give it just a little bit more time. We've just got a few more people that we're waiting for, and should be able to get started very shortly. Okay, I'm going to get started. I don't want to hold you up, and I certainly will end on time. I think the first thing that I would like to just say is that I'm assuming that you were on the session last week, so I must apologize that that was unfortunately a fail. We were highly stressed. We just couldn't get the cameras and everything to work. We had unfortunately done a security upgrade, and that seemed to have stymied us and caught us off guard. We've done tons and tons of webinars like this, since the inception of COVID, and it's never happened. So I'm really sorry that you wasted that time, and really grateful that you have come back today. I do believe that this will be valuable for yourself and also very importantly to your workforce. So to get started, I just want to cover what the promise was of the session, and that is that we essentially are going to focus on understanding, what does the post-COVID financial recovery look like for your staff? What can you do to assist staff that are distressed? And I'm not really referring to staff that might be on an EAP program, some kind of an employee assistance program where they've really hit the wall, and they need some kind of intervention like debt counseling. From our perspective as money coaches and as financial educators, we see that the problem really persists for about 75 to 80% of a workforce. So in other words, it's not what I'm not referring to today, and certainly that isn't a whole nother discussion where somebody really needs debt counseling and is really is having 100% of their salary deducted through creditors. That's a different story. What this is about is that what we have seen, and I'll show you the stats, that for the most part, the bulk of employees working in any environment, whether it be tech and they're earning these high salaries, or sophisticated financial services companies, or whether you got mining staff, whether you got people that we are facilitating and they're having trouble with literacy issues, we see that the financial issue persists across the entire salary band. We see that there's no immunity, and regardless of what people do for a living, what their job title is, what their salary is, what their level of education is, we just see that there is, as I said, no immunity right the way through, and you'll see that coming through in the stats that we measure pre and post our courses, and I think you'll see a very strong story coming through there. Also importantly is, how do you measure the impact of your staff's financial issues at work? How, from a human resources perspective, can you add value to the business and assist in improving even bottom line, even profitability of the business through understanding the financial impact and what it's doing to staff? And then, of course, how do you set your staff up for a great financial 2022? It does feel like things have eased. It does feel like things are a little bit back to normal with vaccination taking place in the workplace and all sorts of other things. But for the most part, it's seeming like it's starting to turn around. And let's get going on all of this detail. So I think the first place to start is to say to you that we are going to assume that there has been a lot of impact, and unfortunately, I actually was on a session this morning listening to 3 different economists talk about the impact, and it is very, very clear that most of the financial impact that's been felt during the last 2 years has really been on the lower end of the market. People losing their jobs, getting downsized, or just literally unemployed. There's been a huge, huge impact, which I'll show you that stat now, also on the family environment. But the bottom line is that even before COVID, 94% of the population would work their whole lives and they would end up broke. And if you want to understand the 2 major drivers, in other words, only 6% of people who've done the hard miles, built a career, worked their whole lives, try to save money, try to be conservative, have made it. The other 94% haven't. And the 2 main drivers are, is that if you look at the statistics in South Africa, you'll see, first of all, if you just take a look at the bottom of the screen there, you'll see a big 76%. And what that is showing is that on average in South Africa, 76% of what people take home gets spent on credit. It gets spent on debt. And of course, that would mean that if they had to pay all their creditors every month, then they would only have 24% of the money to live off. And no one can live on 24% of their salary. It's an impossibility. So what South Africans have learned to do is kind of borrow from Peter to pay Paul, make a plan, use machinitas, micro lenders, payday loans, and all sorts of stuff, which really, it doesn't solve the problem. Being good with money and being in a solid financial position where you feel stable, you've got resources for emergencies, you're able to facilitate the kind of lifestyle that you're looking for, and very importantly, building yourself a financial future, which is really the point. I mean, wealthy people go to work to build wealth. Well, wealthy people don't go to work to earn a salary to make it to the next payday. That's what 94% of the population do, and that's why they end up where they end up. So the other driver is, you'll see that 0.7% of, this was the savings rate from 2020. What we did see is that it was a sharp improvement on what previously was actually happening before COVID. I think when COVID hit, and this is my point, when COVID hit, people finally understood how financially vulnerable they were. You got this feeling if you were impacted, then you knew about it. But even if you weren't, you were worried about the job losses that you're seeing around, whether it be your friends, your family, or directly within your own business. And all of a sudden, you realize that there's very few months that you actually have available in savings or through investments. And in South Africa, with a savings rate of 0.7%, it means that people have got nothing in the tank. They've got nothing for today, and they've got nothing for their financial futures. On top of this, and this is another serious issue, is that this was a TransUnion stat that was issued very early on in COVID. We know this to be true now that we've been dealing with it for 2 years, is that 81% of consumers indicated that they had an impact at home financially. Now, if you've been fortunate enough to work in a business environment where your salary wasn't cut or cut off completely, then what we found is that a massive percentage of people were being impacted because of the family taxation. So in other words, a close friend, family member, cousin, mother, uncle, whatever it may be, lost their job or lost a major portion of their income or your spouse's income, and that in itself had a huge impact. I felt this myself. This was really, really scary. My wife has had a business in the beauty industry for 25 years, very, very successful business. She's done amazing things in her career. And as soon as COVID hit, within the first 2-3 months, she came to me. She had cut her salary completely. She was retrenching 25 staff. And I saw what it looked like when somebody wakes up in the morning and actually cries at work all day because of the issues and the stress and the kind of pressure. And unfortunately, that is what happened. And thank God we are recovering from it now, and things are a lot better. But essentially, if we take it down to, so what I'm saying is whether it was COVID or no COVID, the stats were terrible prior to COVID. The stats are still terrible, but I'll tell you this much, that throughout the last 2 years, we have seen the same financial behavioral changes taking place with our learners, taking place from really somebody who doesn't understand how to manage money well, right the way through to making huge progress. And COVID has not dampened the progress that we have seen in our business of people that have taken the time to invest in themselves, to get a financial education and finally get on top of it. So I'm going to talk to you a little bit about just the general personal financial issue that we have. And I'm going to start off by just saying to you that there's 3 kinds of people. You get people that are building wealth, you get people that are just getting older, which I'll explain to you in a second, and then you get people who are getting poorer. So the difference between the 3 is that a person who's getting older, let's say for instance somebody earns 15,000 Rand a month and they spend 15,000 Rand a month, what that means is they're not investing any money and they may not be getting themselves into any debt, which means that their current financial position is just staying static. So they're not saving anything for tomorrow, and it means they're going to continue their whole entire lives to run on a treadmill, and as soon as they stop earning money, well then they'll have no money to live off, and we consider that just getting financially older. So from a wealth perspective, it simply just means that if you earned the 15,000 Rand, that you took a portion of that, let's say 1,000 Rand, and you put 1,000 Rand towards investing money, not 1,000 Rand which you have gone and put into some kind of savings account which you intend spending, because that is savings. There's a big difference between savings and investing. Saving really is specifically for money that you intend to spend. This could be in preparation of your kids, come back to January and get school equipped, or it could be the holidays that you want to take, it could be the hobbies, and essentially that's where savings really plays a part. Investing is the long-term game. Investing is taking money that you've earned today and growing it for extended periods of time so that at some point you're wealthy. So let's just stop for 1 second and let's just talk about what that really means. In order to be wealthy, and this is a huge misunderstood thing, we've been around the financial education space now for over 2 decades. We've been doing online education now for about 8-9 years in the financial education space. We've got this amazing partnership that we've developed with iLearn. Our business also develops very large-scale, scalable financial education programs, even for banks and insurers, where we educate into their customer base. So we have a lot of experience at understanding the mysticism around money and the confusion that people have. And we're talking about even educated and sophisticated. Really what we see is that there's a big disconnect. So from a wealth perspective, essentially it's like this. You're going to permanently need a salary till the day you die. Doesn't matter how old you are, you need a salary. Why? Because salary covers expenses. So for as long as you have expenses in your life, you're going to need a salary. The difference between working and retiring is quite simple. It has nothing to do with age. It really just means that what you have is a big enough pile of money that you have developed through your investing to be able to draw a salary out every single month when you stop working. And that's it. So the bottom line is the first challenge is to learn how to manage money. And this is where it all goes wrong. So as I showed you in the stats, people are not even getting to the savings or the investing piece because they are stuck in this place where they just literally can't even manage the salaries that they earn. So this is why we see such huge changes, because what we are able to fix as money coaches is we're able to help people unscramble the mess. The truth of the matter is like, here's a simple question. And this kind of makes the point, because I don't want to make it for you, but I thought, if we're sitting in front of each other, it would be quite nice to make this a bit interactive. So let's just try and do that even through a webinar. So please answer that question for me. How many months out of 12 do you think people spend more than they earn? And maybe, I guess in this case, talk about your own staff. And if you don't have staff, well, then talk about what you think people generally do. But if you could just please help me just in the question section, just go in and put the answer. Just literally put a number. However many months out of 12 you think that people spend more than they earn. If you could just help me by putting that number, I'd appreciate it. And just to get a feel for where your head is at on this. I don't seem to be getting any answers, so I'm not sure if maybe you've put it in the chat. So I'm going to say type it here. Okay, I'll move on. It's possibly that you don't feel like answering, or maybe just going to just watch this afterwards, but let me move on. So here's the bottom line. If we were sitting with a large group of people, you would see that we always unanimously see that most people say 12 out of 12 months. There's the odd person that says that they think people overspend 6 months out of 12. I can tell you right now from experience that it's somewhere between 10 and 12, and in fact 13. 13 really means that you've blown your bonus. So the bottom line is that what we are seeing is that the trajectory financially for most people is what they're doing is they are getting 1 month older and just getting poorer. Because when you overspend, you are either using money that's invested or money that you've saved that you shouldn't be spending on this, or alternatively, what's happening is you're using more debt. So technically speaking, the question you've got to ask yourself is, are you getting wealthier, poorer, or older as you continue to work and build your career? And the very important question today is, how does that play out for your staff? Do you think your staff are building wealth? Do you think your staff are just getting older? Or do you think your staff are getting poorer? So essentially, this is what the ideal framework of a good financial plan looks like. And when I talk about financial plan, I don't mean financial planning in the sense that most people understand, where you go and you meet with a financial planner, you put together a view of what your future looks like, and you buy an investment, or you buy insurance, or you buy life cover. That is not what we do. We are money coaches. We do not sell any financial services products. Our objective is to help you drive profit. So in other words, you're earning an income, a percentage of that should be going towards your expenses, and the money that comes out of your salary should make you profitable. There should be a reasonable, healthy percentage of money that goes towards profit. And when I refer to profit, what I'm talking about is I'm talking about money that is going towards investing. It's going towards savings. It's going towards making you crash proof. So that is our goal as money coaches, and that is what we are good at doing. We are helping clean up the mess. And instead of having somebody at 75% of what they're earning going towards debt, we need to bring that down to 25%. We need to help them free up their cash flow so that they can start to spend money on the things they need to for their lifestyle. They can start allocating more and more money to get rid of that debt, and then ultimately to start building up a savings portfolio as well as an investment portfolio. So here's a question for you: is what financial metrics are you currently measuring in your business? So you might have an employee assistance program. What metrics are you measuring? So you're spending money on developing your staff or giving them the benefit of having a financial solution if they find themselves in trouble. And what metrics are you seeing in terms of that provider being able to solve that problem? From our experience, what we see is that in most cases, you might be getting the metric of how many people applied for debt counseling this month. You might be getting a metric of how many people may have sat and got a budget for the month. Generally speaking, it's a tiny percentage of the population, and premiums are being paid for this kind of service to really only help a very, very, very small percentage of people. And in most cases, if it's a debt counseling service, there shouldn't even be fees charged for that, because the debt counselors make money through the process. Essentially, your staff are leads that you are giving to them, which they then monetize. So really, they shouldn't even be charging for that service. So it's important just to say this in terms of how are you measuring this. So it's just food for thought. I want to show you the kinds of things that you could be measuring and should be measuring. So the first question I wanted to ask you, I saw from sort of the particular participation rates that you may or may not feel like really answering this, but here's the first question. A question that we ask all people who start programs with us. So through iLearn, they are offering financial education programs which are deployed either in a face-to-face or in a digital format, and this is deployed to employees across the entire base or a select group of employees that are of your choice. Now, I can tell you that these are the stats. These stats that I'm showing you are taken over a learner group of over 60,000 employees that we have trained. This is straight down, square down the middle of corporate South Africa, and these are the kind of stats that we have found. So we ask everyone a very simple question. Do you have 5,000 Rand for an emergency right now without using credit? Is the answer yes, or is the answer no? So could you take a 5,000 Rand hit right now without using credit? So this is the answer that we get. we get a yes from 35% of people. So 35% of people say that they've got enough money for emergencies. Now, I think what you've seen, depending on the size of your business, depending on the type of business, but essentially, if you've got a labor force that's coming in, you're going to have absenteeism rates going through the roof because people are saying that they don't have money. You'll see this in a typical month like January, where people have been paid really 45 days ago, and essentially it has an impact. This doesn't just have an impact on people that you may perceive to be earning smaller amounts of money. I can tell you right now that this has a major, major impact even on people at even the most high levels of income in your business. Why? Because emergency funding is at the base of a financial plan. Why? Because if you're trying to invest money, what used to trip me up in my early 20s when I got into a lot of debts and I couldn't understand how to navigate all of this was the fact that I would be investing and investing and investing, life would happen. I'd essentially phone my broker and say to him, listen, I need the 5,000 Rand or I need 10,000 Rand because I've had an oops and I need to solve the problem. He'd give me a whole explanation of you shouldn't be selling now, the timing's wrong. And it was just a really simple situation. I needed the money, give me the money. So I would either cash in my investments or I would go and get myself into more debt by using a credit card, an overdraft facility, or moving money out of my bond. So in other words, people who are trying to get rid of debt, and I can tell you now that from the debt stat, and you can see it over here, 52% of participants tell us that they're struggling to get rid of their debt. So they're not just struggling with debt, they're struggling to actually just get rid of it. What means is that the debt is growing. So they've got a very substantial amount of their salary now going towards debt. And the real effect that this also has is that it means that people cannot come out on the salaries that they earn. Because the salaries that, the affordability of salaries is horrendous. 70% of people in corporates across South Africa, across industries tell us that they spend more than they earn. Now I can tell you that when your staff are spending more than they earn, they are blaming their income. They are saying the reason that I can't earn or I can't afford to live the way I want to live or I can't afford to live in my salary is because of my boss. It's because of the environment, it's because of my manager, it's because they're not nice to me. And I can tell you that that's it, but it's not true. And I'm going to show you very shortly how those stats change just towards the end of the session. I'm going to show you the kind of sharp differences that can be made by helping somebody just to understand what is going on in their financial life, the conversations they need to be having at home, how the creditors operate, how the call centers are geared to keep you on a drip, to continue to keep you sort of running on that treadmill, never getting rid of your debt, and you'll see how that can be simplified. So 8% of people tell us that they actually know how to improve their financial situation. And of course, what you would see closely tied to this is very high levels of stress. So 63% of people worry about their money daily or weekly, with 56% being overwhelmed by debt. That is very, very high stats, and I can tell you that that's what you can expect. And that's how I was saying to you, that we see that on average, 70% of people are spending more than they earn. I've had this debate with many a CEO who's reluctant to pay the fees, to train the staff, and the answer is, you know, we're an engineering business, we only hire cum laude, we've got these very, very smart mathematicians, and I can tell you now that their stats are the same. People don't have emergency funding because people are people. Because people have got children, people have got families, people have got obligations, people are trying to improve their lifestyle. People come from nothing and they're trying to make something. They're trying to drive a nice car, and they're not financial planners. Even though they might have some kind of finance degree, it's not applied to personal finance. And personal finance is a completely different ballgame. So let me move on from this and let's ask another question. Is how does this translate in your environment? So having 70% of the workforce not being able to afford their salaries, what does that do to your business? So I thought I would put together some of those issues which you can actually quantify. So if you sat with your financial manager or your CFO in your business and you actually started running this kind of research in your business, you would actually understand how this works. So the first one, salary increase, demand pressure. That's a simple one. No matter what you pay your staff, if you gave your staff a 30% increase in their salaries, I'm saying to you that doesn't help. I'm not saying don't do it, and I'm not saying tell them that you're not paying them because this money coach told you not to. I'm saying to you that if you're giving more money to a person who fundamentally is a bad money manager, that only understands short-term solutions to long-term problems, and I can tell you it's an ignorance. It's not because they're stupid. I'm telling you that the most educated, high-earning people in your business have got the same problem. they need more money. And if they don't get more money, then what happens is they start becoming ineffective in your business. They start looking around and you start seeing churn rates. A lot of our clients in big call centers, they've got a 10% churn rate per month. So what's happening is you've got these call centers with 1,000 people sitting in it, and you've got these youngsters who for 1,000 Rand will go and get another job elsewhere because they believe that that's the problem. They believe that they don't earn enough. They believe it's some issue with their compensation package. They believe it's they're selling the wrong products. A lot of it is not true. If you look in their businesses, you'll see that their top earners are still earning good money, regardless of whatever the bottom or the average earners think. But the bottom line is people churn. So people leave an environment that they actually like with people who they enjoy working with, where they actually have been there for a few years and might have been ready for a next promotion, but it's causing people issues. So companies are losing a lot of intellectual property. It costs a lot of money to recruit, train, get somebody passionate about your business, have them ingrained with all the IP and the understanding of the business, and they get lost. They get lost because the senior performers are leaving. And in some cases, what you're having is real disruption at work where people don't even come to work. And they're using their overtime and they're using their absenteeism to be able to come through. So it's a real problem. If you're in a manufacturing business, what we always see is it's a major problem. At various times of the year, there's increases in production and staff get overtime. They then escalate their living expenses to that point, and all of a sudden what you have is staff who have to do overtime. So how do you make sure you do overtime? You reduce productivity. If you reduce productivity, it means you need to work longer. So you need to work longer. Now, eventually what you have is you have this increased payload, which wasn't anticipated, or it's not healthy for business. But even on top of that, you have exhausted staff, because you have staff that are just working non-stop 7 days a week, or as much as they possibly can, because they can't afford to live on less. So I'm saying to you that the impact of business, all of these things can be measured in your business, and you can tie it back to the level of affordability that your staff, the level of distress and dis-ease that people have got around money, and you'll see that as those numbers come down, these numbers improve in your business. So moving forward from that, here's this very simple calculation that you can do in your business. I thought it might just be a good one. PricewaterhouseCoopers did some investigation, and they found that 49% of staff are spending 3 hours or more a week distracted because of financial issues. So I just did a small calc for you here. I said 200 people working in your business. If the average salary was 12,000 Rand and the hourly rate was 70 Rand per hour in the business, that would mean that you would be burning nearly 1,200 hours per month. If you work that back to the 70 Rand, you'll see that it's costing the company directly 83,000 Rand a month in distraction. That's nearly R1 million a year in distraction. And that's not got to do with people leaving, and that's not got to do with the churn rate and new people coming in. You have to recruit them, which costs money, then to train them, then the brand damage, then the low productivity levels until they get up to speed. It's an enormously expensive task having people lose, not retaining staff because of a financial issue. So I hope that adds value, and I hope you feel that that is something that you can take away from the session that gives you something to actually implement and understand at work. Go back to your current EAP and see what you're measuring and see if this is actually delivering the change. And if not, well, then I definitely suggest that what you do is you talk to iLearn and see how they can assist you with this program. So the programs that I'm referring to are digitally deployed. I did say to you that there is obviously face-to-face, and that is something that they can do. But for the most part, a lot of the programs have been scaled, very cost effective, can be done on any digital device. Staff can be doing it at work, doing it at home. There are programs for individuals, there are programs for couples to do at home. On the learnership side of things, they've implemented some really amazing programs. If you go to the iLearn website and you look at the financial education piece and you see what they're offering, you'll see that they are taking real care of those learners. So for instance, if I can just explain that to you. You spend a lot of time working on a BEE scorecard, and you want to uplift and you want to transform. So you run some learnership programs, and you have some youngsters coming into your business, and those youngsters in essence are coming in and they're getting a real amazing opportunity. With the level of opportunity in South Africa where it is, where there's such high levels of unemployment, somebody comes into the business, and I can tell you that we're seeing it. The stipends are being misused. these new staff are going home in these high levels of taxation because there's such high levels of unemployment. They literally do not understand how to manage that money and stop even on the learnership, and providers have to find new learners. And very importantly, for those learners that are successful and they make it through the learnership, and and I know that just even to get to work, even just to complete such a program on these stipends, is somebody that's showing real grit. They really are determined. They're doing what they have to do. They're living on really a very small amount of money, but they're getting opportunity and they're getting experience. So here's where it all goes wrong. You have these youngsters coming into the economy, coming out of school, coming into your businesses. And I can tell you now that the first thing that starts happening to them from a financial perspective is that they're going to get romanced by banks, lenders, and retailers. Now, that is the nature of their business. I have no issue with credit per se. What I have issue is how strongly it gets marketed to people. So the problem is that we know that being good with money is a DIY issue. You have to learn to do it yourself. Nobody's going to be able to do it for you. No financial planner can do it for you. Financial planners sell products. They're very good at what they do, but they can really only help people that have actually got money to invest into, mitigating risk in their life through insurance products and investing their money to build the financial future or sustain or create emergency funding and things like that. But the messy stuff that takes place before is a real deal breaker for people. So they've gone through the process of completing a learnership as an example, and they don't understand the creditors. They don't understand what they're being offered. They just think, well, I've got a new job, just like I did when I first started working. Exactly the same thing happened to me. I get SMSs, I get a phone call from the bank, I'd go and see some private banker, I'd walk out with a credit card. I like the fact that they told me it was a gold card. It was all nonsense. The bottom line is that they had just sold me my own future salaries and got me to spend it, because when you go and you open up an account and you just want to go and buy a pair of shoes for 500 Rand, and you get a store account for a facility of 2,000 Rand, you go and you spend the 2,000 Rand because you need a duvet as well, and you need this and you need that, and your child needs something, and that's the way it works. So we have to protect the interests of these people coming into the economy. We have to protect the interests of these people working in your business. They are sweating to reach deadlines, to do what they need to do. From my experience, most people are enthusiastic, they're ambitious, they do what they need to do, but they are so broken from just having the stress of finances that they just don't know what to do anymore. They believe it's their salary, so they believe that they're in your business, but they're stuck. And if they weren't stuck, then things would be okay, but they're stuck, so, well, they're going to try and just make it through their workday. And that is not true, and this needs to be explained to people. And we need to equip them and enable them with the skill, the knowledge, and the confidence to be able to unscramble this mess so that they can start to experience a much better value proposition on their salary, where they've got a better perceived value of their salary, and start understanding that their salary really is the engine that they can use to build themselves a financial life. It's unfortunately not a skill that we're born with. Very few people are even fortunate enough to have learned that kind of thing at home. And the reality is that it's not something that you learn by chance. You learn it through mistakes. When you learn it through mistakes, it means you've got credit, it means you've got interest, it means you've got drama. And it also means that by the time you come home, how do you solve this problem? Because most people don't have the bandwidth. They literally just don't have the bandwidth to even just deal with money under normal circumstances, especially if they're in a relationship, especially if they've got children, especially if they've got all these other responsibilities. They just don't have the time to sit and work this out. And that's what these programs are designed to do, to be able to future-proof them and to be able to really just put them on the right track. So this is the kind of changes that we experience. We see that from, as I said to you, based on 65,000 people, we see that from 35% of people saying that they don't have money for an emergency, we see that within 3 paydays, these stats are polled, that jumps to 69%. So 69% of people now say, I've got the emergency fund in place, because they get it and they understand it. You might be sitting there saying, well, how did they put that money in place when they got all this debt and they don't understand? It's part of the technique. It's part of understanding the kind of conversations that you can have with creditors around being able to create emergency funding, so that when you start your repayments to a creditor, you explain that life's going to happen and I want to start on this kind of date. And this is the stuff that we teach. We help people to put together a schedule, understand the timeline of how these things work, how to get rid of debt. And that's why we see from 52% of people saying they're struggling to get rid of debt drops sharply to 8%, and 70% of people saying that they can't come out on what they earn drops to 25%. And I challenge you, Because if you ran a pilot and you saw this in your business, you'd be like, there's no ways that these kind of figures are true. There's no ways that we will see these kinds of changes with my staff. Run a smaller group then. If you've got 500 people, go and put 30, 40 people through a program, give it 2 to 3 months, look at the pre, look at the post, ask staff personally what changes that they've experienced, and this is what we see. Our business literally gets testimonials, hundreds a month, unsolicited testimonials of people writing into us because of the kinds of substantial changes that they've been able to make through these kinds of programs. So from 8% of people, I think that's an obvious one, saying that they don't know how to improve their financial situation, it would rise. There's always a couple of people that don't understand, but further to that, that's the 2 to 3% of people that need that debt counseling. So even if you give them everything, even if they had a degree in finance, in investing, no matter how sophisticated you want, the current position doesn't allow it. It is too severe. You could have somebody who's married, community of property, they're in a good financial position, their spouse is absolutely in a disastrous situation, having the car repossessed, having house repossessed, and you, because of the nature of how you married, get pulled down that road with them. And there is things that you need to be able to do and can do to be able to solve such critical situations. But that's the small percentage. I'm talking and saying 70% of your staff are in this kind of situation where sort of they're up to here financially. They've got very little wriggle room in the money that they're earning. And as you can see, the level of stress comes down substantially when people really get control of their finances. So the key takeouts here is, what are you looking for? What are you looking for in the ability to help people with their finances? You want to make sure that whatever program you're implementing at work, you want to make sure that your staff have emergency funding. You want to make sure that they're able and are actually getting rid of their debt. You want to make sure that they're coming out in their salaries so that the value that you give them and the balance of the relationship that you have, i.e. they achieve your goals, you help them achieve their goals, that is a healthy relationship to have with staff. You don't want staff worrying about money. We see them worrying on a daily basis about money. It's a huge, huge stress. And what you want is people starting to invest and begin to invest if they're not. So the value proposition of this type of employee benefit is enormous. It's saying to staff, we want you to get under control. We want you to have your finances under control. We want you to be able to translate the hard work and effort that you make in helping us build this business into being able to build a life for yourself. And that comes through in the communication that you would receive from iLearn in terms of how they would launch this kind of campaign in your business. And it would be something which really is not just a value add. It might just look like it's an internal brand building exercise and the company's being paternal. But as I've shown you through this presentation, that this will actually have an impact directly on your finances and the financial health of your business. The two are really just tied together. Healthy financial staff impacts a healthy financial business. It improves growth, it improves profitability, it improves productivity, it improves customer service. And these are the metrics that you should be looking for in whatever programs you are busy implementing and investing in. So it will significantly increase the level of loyalty from staff. And importantly, if you're using your scorecard to drive transformation and you're giving people SMEs and things like that opportunities in life, I can tell you that unless the personal finance piece is taken care of, you have a very, very high chance, based on people's personal finances, there's about an 80% chance that that money is going to be wasted. Because even if you're giving it to an SME, as soon as the person starts making money, they start qualifying for debts, and so the spiral starts. They start spending their VAT money, they start spending their PAYE, they start killing their cash flow, and they're unable to grow their businesses. And this is what's killing South Africa. You've got this huge amount of people that are in the middle of the economy who should, by all means, based on what they are earning, be able to start to support more widely their community, to be able to reinvest into it, to develop and develop and develop, but they themselves are being brought onto their knees. You take a look at any of the stats of the degreed employees, it doesn't change. It's scary. You know, often we meet employees that always think we're talking about only their lowest sort of income staff. We're talking about everyone, because that's what we see. So that does it for the presentation for today. I am happy to take some questions. We do have some time allowed for that right now. So if there's anything that's on your mind that you would like to ask me, you're welcome to put it into the chat. If you would like to just get hold of me directly, you can contact info@ilearn.co.za. we are money coaches and we can field some of those questions, but I really do implore you that what you should do is contact iLearn. I'm assuming that you're probably one of their clients, and if not, you probably should be, and have a chat with them. Go onto their website, check them out. If you would like some information about how they can assist your employees to make this kind of impact in your business, have a chat with them and they'll unpack that for you. So I hope you found value in today. We ran through, as we discussed, we would discuss the metrics that you should be measuring in your business, how it impacts, and of course you can understand that by running an initiative like this, where essentially what you're saying to your staff is, we want you, we're coming through COVID. Please God, it continues. Please God, the strains and whatever it is medically continues to be at this kind of level of, with the death rates and all that kind of stuff and veracity. The bottom line is, as people and as things start to shift and start to improve, and in the economists that I was listening to this morning, they're seeing that there's some nice improvements coming through and things are starting to stabilize and spending of consumers is up and so on and so on and so on. The bottom line is, you could help your staff to accelerate that. You can help them to really put things on the right track, get on top of their debt, get on top of their spending, get on top of the value that they could be driving for themselves. And I hope you're able to take that away from the session today. So thank you for the time. I don't see any questions, and appreciate the fact that you came back to the session after it went pear-shaped last week, and have a good rest of the afternoon.